stop scrolling and look at your portfolio right now, because we are witnessing a silent regime change in the crypto markets that most retail investors are completely ignoring. While everyone is distracted by the latest meme coin volatility or the Bitcoin halving cycles, Ethereum is flashing a warning signal that we have not seen since late 2018. There is a massive divergence occurring between the price of Ethereum and its underlying network revenue, and if you are holding ETH today, expecting a repeat of the 2021 bull run, without understanding this shift, you are walking into a trap. In the next 8 minutes, we are going to deconstruct the raw on-chain evidence that suggests Ethereum is morphing from a growth asset into something entirely different by the year 2026. We are going to look at the undeniable cannibalization by layer 2s, the institutional supply shock that is building in the shadows, and ultimately answer the question, is Ethereum a dead chain walking, or is it the ultimate value trap before a vertical move? Let us get straight into the mechanics of what is actually happening. To understand where Ethereum is going in 2026, we first have to accept the brutal reality of the current landscape. For the first time in history, the narrative of Ethereum as the undisputed king of smart contracts is being challenged by actual liquidity, not just marketing hype. If you look at the decentralized exchange volume over the last quarter, there were multiple days where Solana flipped Ethereum on mainnet volume. This is not something we can brush aside as noise. Retail traders are voting with their wallets, and they are choosing speed and low fees over decentralization and security. However, this is where the average investor stops their analysis, and this is exactly where the smart money begins theirs. If you simply look at transaction volume, you might conclude that Ethereum is dying a slow death. But let us look under the hood at the total value locked and the movement of whale wallets. While retail activity has migrated to Solana and Base, the heavyweights, meaning the wallets holding more than 10,000 Ethereum, have actually increased their accumulation by 4% over the last 6 months. Why would the smartest capital in the space be buying a dying asset? The answer lies in a fundamental shift in the business model of Ethereum that occurred with the Dencun upgrade earlier this year. This upgrade introduced something called blobs, which drastically reduced the cost for Layer 2 networks to settle data on Ethereum. Before this upgrade, Layer 2s like Arbitrum and Optimism were paying massive rent to Ethereum, burning huge amounts of ETH and keeping the supply deflationary. Now, those fees have dropped by over 90%. This has caused Ethereum to flip from being deflationary back to slightly inflationary in recent months. The ultrasound money narrative that drove the price to $4,000 has been temporarily broken. This is the value trap argument. The argument is that Ethereum has outsourced its revenue to Layer 2s, effectively cannibalizing its own cash flow to survive. If you are finding value in this deep dive into market mechanics, consider subscribing to the channel to stay ahead of the crowd, as we dissect these institutional trends every single week. Now, let us pivot to why this revenue drop is actually a strategic Trojan horse for 2026. We need to stop thinking of Ethereum as an operating system like the iOS store, and start thinking of it as the United States Treasury bond of the digital economy. The game being played right now is not about who has the most daily active users. The game is about who secures the highest value assets. By 2026, the primary driver of Ethereum price will not be retail users swapping meme coins on Uniswap. It will be the tokenization of real-world assets. We are already seeing the first signs of this with BlackRock and their Buidel fund. Larry Fink and the Titans of Wall Street are not launching their tokenized funds on Solana. They are not launching them on Cardano. They are launching them on Ethereum. Why is this the case? It comes down to one word: finality. Institutions do not care about paying a 1-cent transaction fee versus a $5 transaction fee. They care about settlement assurance. They need to know that if they move $100 million of tokenized treasury bills, the network will not go down and the consensus will not fork. Ethereum is the only network with a track record long enough and a validator set large enough to offer that guarantee. So, when we look toward 2026, we are looking at a market where trillions of dollars of traditional securities migrate on-chain. Even if Ethereum only captures 10% of that market, the demand for ETH as the gas to pay for those settlements will dwarf the retail demand we saw in 2021. However, there is a massive supply shock lurking in the background that nobody's talking about. Let us look at the staking metrics. Currently, over 27% of the entire supply of Ethereum is locked in staking contracts. That number is rising steadily every single month. When you combine staking with the supply locked in bridges to Layer 2s and the supply locked in decentralized finance protocols, the actual liquid floating supply of Ethereum on exchanges is at a multi-year low. We are seeing exchange reserves of Ethereum sitting at levels we have not seen since 2016. This creates a powder keg situation. If we get a catalyst, such as a regulatory clarity event or a surge in institutional inflows through the exchange-traded funds, there is simply not enough Ethereum available for sale to meet that demand without a massive repricing. The sellers are exhausted. The people who wanted to rotate into Solana have already done so. The people who were scared of the regulatory crackdown have already sold. Who is left holding the bag? It is the long-term believers and the institutional custodians. These are hands that do not sell for a 20% gain. These are hands that are looking for a 500% return over a 5-year horizon. Before we discuss the specific price targets and the potential risks that could derail this thesis, if you want to align your portfolio with this institutional data, make sure you hit the notification bell so you never miss an update when the market structure shifts. Now, we must address the bear case, because a good strategist always looks at the downside. The risk for Ethereum in 2026 is not that it dies. The risk is that it becomes the Yahoo of crypto. Yahoo did not die. It is still around, it still makes money, but it lost its relevance to Google. If Solana or a new high-performance chain solves the validator centralization problem, Ethereum could lose its monopoly on high-value settlement. Furthermore, we have to watch the rest staking narrative closely. Protocols like EigenLayer are allowing users to stake their ETH multiple times to secure other networks. While this increases the yield for holders, which is bullish, it also introduces systemic risk. If a major restaking protocol gets hacked or suffers a slashing event, we could see a cascade of liquidations that would crush the price of Ethereum in the short term. This is the value trap scenario. You buy ETH for the yield, but the underlying asset depreciates or suffers a systemic shock. However, my base case for 2026 remains highly bullish, but for different reasons than the last cycle. In 2021, Ethereum went up because everyone was using it. In 2026, Ethereum will go up because everyone is building on top of it. We are moving toward a modular future. Ethereum will be the settlement layer, the bedrock of truth. Layer 2s and Layer 3s will be the execution environments where users live. This means Ethereum effectively becomes a business-to-business chain, rather than a business-to-consumer chain. Historically, business-to-business platforms command much higher valuations and much stickier moats than consumer platforms. Think of Microsoft versus a trendy gaming company. The gaming company has hype, but Microsoft runs the world economy. Ethereum is positioning itself to be the Microsoft of the blockchain era. So, let us talk numbers and projections for 2026. If the total crypto market capitalization reaches $10 trillion, which is a conservative estimate, if we follow the logarithmic adoption curve of the internet, we have to calculate Ethereum's dominance. Currently, Ethereum dominance sits around 16 to 18%. Even if that dominance drops to 12% due to the rise of competitors, 12% of a $10 trillion market puts Ethereum at a $1.2 trillion market cap. That implies a price of roughly $10,000 per coin, assuming the supply remains relatively stable. But here's the kicker. If the institutional tokenization narrative takes hold, Ethereum could see a premium valuation similar to how tech stocks trade at high multiples of their earnings. We could see Ethereum trading not just on speculation, but on the yield it generates from securing trillions of dollars in assets. If Ethereum becomes the risk-free rate of the digital internet, the demand for that yield will compress the supply even further. So is it a dead chain? Absolutely not. The developer activity is still higher on Ethereum than any other ecosystem by a wide margin. Is it a value trap? Only if you are looking for a quick 10 times return in the next 2 weeks. If you are looking for a reliable, high beta play on the future of global finance, Ethereum is currently trading at a massive discount relative to its future utility. The market is currently pricing Ethereum as if it has already lost the war to Solana. The data suggests that Ethereum has simply moved to a different battlefield, one where the stakes are higher and the competitors are fewer. Retail is selling because the gas fees are too high or the price action is boring. Whales are buying because they see the infrastructure being laid for the next decade of finance. Do not let the boredom of the current price action shake you out of a position that has the strongest fundamental backing in the industry. The rotation back into Ethereum will likely happen suddenly and violently, leaving those on the sidelines chasing the green candles. We have seen this movie before in 2020. Everyone hated Ethereum right before it ran from $100 to $4,000. The sentiment feels exactly the same right now. The silence you hear in the Ethereum community is not death. It is the sound of building. Keep your eye on the exchange-traded fund inflows, keep your eye on the stablecoin market cap on Ethereum, and ignore the noise on social media. The year 2026 will not belong to the fastest chain. It will belong to the most trusted chain. And right now, that trust is still firmly anchored in the Ethereum virtual machine. I will see you in the next briefing. Disclaimer: the content provided in this video is for informational and educational purposes only and does not constitute financial, investment, or legal advice. Cryptocurrency investments carry a high level of risk, and you should perform your own due diligence or consult with a certified financial advisor before making any investment decisions.